we look at the history of Septembers, where do we stand from an investment perspective, right? Things have been a little rockier lately. Tech stocks in particular have seemed a little more vulnerable to those higher rate expectations. So how do you put it all together?
Yeah, it's a traditional weak month from a seasonality point of view. I guess it has to do with rebalancing, or it has to do with just that it has been historically that way. So people look at these seasonals. I would point more to October. That's much more of a difficult month. But I do think we're at a juncture here where the macro forces are shifting once again. We've got news out this overnight out of Japan that they continue to look at changing their policy. That's a big macro factor. The stimulus in China is getting through their system. They're increasing lending to the economy, and CPI is back out of deflation. So it does show there's some traction there. So I think the September month could perhaps be volatile as October, but it is all about the economy. It's really about what we're going to have this week too on display: retail sales, CPI and PPI. With this UAW strike perhaps hanging over all of that, that's the macro that drives the markets. I think this is what we're going to be in for in this month in terms of volatility.
And you've been urging caution in terms of investors that are perhaps looking at some of the more riskier assets that they would have kind of leaned towards in the past. And not so much that the NASDAQ 100 is risky, but at the same time, technology as a whole had been under a little bit of fire, at least during the month of August here. So kind of coming out of that, where would you kind of continue to urge caution among investors?
Yeah, you would take into account the valuation. Right? We are at multiples that are high again from the 2021 levels. And so that makes people cautious if you have interest rates sitting here at the top of the range in the 10-year. Right? And that, I think, is where the tension is, that if there is the risk that we are going to break out with rates higher, which is possible, given where the economy is or what Japan is doing, these multiples will contract. That's the mechanics. And I think because we had such an incredible drive of the stock market by just a handful of stocks that are now at excessive multiples, yeah, that continues to be the risk for markets that does reverse, that we're getting some, let's say, mini repeat of what happened from 21 into 2022. I wouldn't call that we go back to that bear market sort of analysis. I think that's not there because the economy has strengthened since last year. It's actually got better. Ever since Powell had his big speech about hawkish and pain, the economy has only improved. So that's reflected in the stock market. I don't think that story has changed, but it's a valuation issue, and that's why we're cautious.
So what does cautious mean for you then? Does it mean hold on your technology investments, don't add, don't subtract, and just kind of hang out right now?
I think that's right, Julie. I think you do not want to increase your exposure at this point. And as you take the Apple story as a good example, as you just highlighted, it came completely out of nowhere that China suddenly puts this news out there of this ban, at least it's reported. It doesn't mean that people are stop using iPhones in China, but the market extrapolates it as this is for future revenue of Apple a problem. And so you cannot really discount those factors with too much of like a complacency just because this new iPhone comes out with all these gadgets and fantastic. We are dealing with high valuation for tech stocks, and you're dealing with macro factors. So I think you don't want to add here, but you don't have to outright sell either. These companies are really, really profitable. So I don't think there's a reason to detract from your position.